Hello and welcome to my channel. This video is part of NISM Mutual Funds tutorial. I have already uploaded chapter 1 to 10 of this playlist, so I request you to watch those videos as well. You would get a better understanding and it would help you clear your exam with good scores. You can get the link to the playlist in the description box at the end of this video as well as on the I button. For this one, we would be covering chapter number 11, that is Mutual Fund Scheme Performance. If you like the video, do hit the like button and do not forget to subscribe to the channel. That would be a real support and motivation for me. Now let's start with this one. So starting with benchmarks and performance. Okay, so what exactly is this benchmark? Benchmark is a standard index against which a mutual fund's performance is measured. Now let me explain this to you. Like you as an individual, when you are investing in any of financial asset, you are having certain target return percentage. Even if that is not fixed, you assume that when you are investing, when you are making an investment anywhere, you assume that you want a return percentage between 10 to 15% or whatsoever. So you make an assumption that this is your target, this is your return percentage that you require by your investment. Now, in the same way, when we talk about mutual funds, we know that there are fund managers. Now, those fund managers are responsible for investing in such a way that they can provide a good return percentage to the investors. Now, what could be this return percentage? There should be some kind of measure, right? How they would measure that, whether they have performed good this time or whether they have not performed well. So always with every scheme that mutual fund is presenting, with every certain mutual fund scheme, there is a benchmark also. So this benchmark is an index, a standard index to which the performance of the scheme is compared. So for example, if the fund manager is managing an equity scheme and he has kept as benchmark the Sensex, the BSE Sensex. So now what he would try to analyze that his scheme, the return percentage from the scheme in a certain period of time, he would try to outperform the BSE Sensex. Whatever return percentage has been provided by BSE Sensex in a certain period of time, that is equal period of time of the investment, the fund manager would also try that the particular scheme which he is managing that outperforms the benchmark. So benchmark, you can understand it in a simple way, the target which the fund managers are trying to achieve or outperform. Outperform means performing better than it. So a benchmark is a standard index. We will see some examples and you'll get a better idea. But just read this line over here. A credible benchmark should be in sync with investment objective, asset allocation and investment strategy. Okay, so we just can't choose any benchmark which is not matching with the scheme objective or scheme asset allocation or strategy. So it should be in suitability with the scheme. Whatever benchmark, whatever index has been set as the target to be achieved, the return percentage from that particular index or that particular benchmark is set as the target. Now that should be in sync with the scheme. So scheme comes with different asset allocation, different investment objective. We already talked a lot about in previous videos that there are different schemes of mutual fund. Equity fund is for capital appreciation. Debt funds are generally more secure and for a safe investment. Then there are hybrid funds which are combination of equity and debt. There are sector funds investing in one particular sector. So there are different schemes. Now, all schemes cannot have one single index or one single benchmark that they are following. It should be in alignment with the benchmark should be in alignment with the scheme objective, the asset allocation, the strategy. So we would get a better idea in the upcoming slide when we would see some of the examples, we would understand it. Let's see that the benchmark for a scheme is decided by the AMC, Asset Management Company, or what you can say as mutual fund company. So it is decided by the AMC in consultation with the trustees. Now trustees, we learned that these are the people who are appointed by SEBI and they try to look after, they try to ensure that mutual fund companies are are following all the regulations and works in the interest of the unit holders. So trustees were the one who were responsible for looking after the regulations and the norms and policies that is being followed by the mutual fund companies. So even when the benchmark has to be decided for any particular mutual fund scheme, the mutual fund companies or the AMC, what we call asset management companies, they need to consult with the trustees, and the scheme information document has to mention the benchmark. We also read that scheme information document is the one document that is providing all the informations related to the scheme, whether which type of scheme it is, what is the investment objective, what would be the benchmark. So benchmark has also to be mentioned in the scheme information document that is available freely for the investors. They can go through it, they can get an idea that how the fund is going to perform and what all are the what we say, what all are the related criteria, related factors that would be influencing that particular fund. AMC may choose to change the benchmark in consultation with the trustees. Okay, just mark this line that it is not necessary that once the benchmark is set up for a particular mutual fund scheme, it cannot be changed. It can be changed. Okay, so AMC, mutual fund companies, they can choose to change the benchmark. And that again should be in consultation with the trustees, as we know that trustees are the one who are in the power and the responsibility to look after the regulations and all. So benchmark could be changed, and it could be for various reasons like change in investment objective. Certain time what happens that a particular mutual fund scheme goes through some changes, the investment objective has been changed, there has been made some improvements, and maybe there is one better index in the market. So again, it is on the choice of the mutual fund companies. It can change the benchmark. The main thing is that the change needs to be justified and documented. Whatever change is being happening, that should be in consultation with the trustees, and again that should be mentioned in the documents, that should be justified enough that for what reason it is being changed. Now let's come to look after this price return index and total return index. So earlier what happened, the mutual fund schemes, they were benchmarked to the price return variant of an index, that is PRI, what we say. Now PRI only captures capital gains of the index constituents. So that's the main difference that we would be seeing. That total return variant of index, now it has been modified from Feb 1, 2018. Now the mutual fund schemes are benchmarked to total return of index, and what happens that it's more clear, it gives more clear picture, because total return of an index, they takes into account all the dividend or interest payment. Dividend payment also makes a good amount of countable money in certain investment proportion of the investors. So even the dividends, even the interest payments on the debt schemes, that all is included in total return index, that is TRI, that which is mutual fund schemes are benchmarked to. But previously it was only benchmarked to PRI, that is price return index, and price return index was not capturing the value of dividend and interest payments. They only used to capture the value of capital gains. So whatever the index were constituents were, whatever capital gains were happening, the profit, that was only taken into consideration. But with the improvements by the year 2018, the dividends and the interest payments have also been included. So now it has been more difficult for the mutual fund companies, or what we say the fund managers, to outperform the benchmark, because now the dividend and interest payments are also included. So it would be more responsibility to perform better than the benchmark, to provide the same source of dividends and interest payments in related mutual fund schemes. So this becomes more transparent, but yet a little difficult to outperform as compared to, but a good initiative from 2018, before it was price return index. So the difference you need to consider over here, just consider the difference in mind, that PRI only captured the capital gain, the profit that one gets from selling of the asset, but TRI, that is total return index, it takes into account the dividend as well as the interest payments. Now let's come looking after some of the examples which would make it more clear. So benchmark for equity schemes. Just look after here that we saw in the first slide that whenever we are choosing a particular benchmark, it should be in alignment with three things. Okay, that was investment objective and investment strategy and asset allocation. So now we will get a clear idea that how does it matter, like what benchmark should be chosen for what scheme, how that should be decided. So just see, it depends on scheme type. Okay, there are two examples that have been taken. So first one is diversified equity fund. If it is diversified equity fund, it means the most of the allocation of the money would be in equity related instruments, more than 65%. And for this one, the benchmark that could be considered should be BSE Sensex, Nifty 50, BSE 200, Nifty 100. Okay, let me give you an idea about this BSE Sensex. Sensex is also one of the oldest index. It is related to Bombay Stock Exchange, which consists of 30 large cap companies. And when it was started, it was, I think, about at the value of rupees 100 back in the year 1978 to 79. But right now it is at the valuation of 50,000. So this is how it has been changing with the trading and the market fluctuations happening. So whenever we are talking about diversified equity fund, we know that most of the allocation in the equity related instrument, and that too is diversified within some sort of companies. So what should be a suitable index? It could be BSE Sensex, it could be Nifty 50 as well, because these index are well diversified with different companies, different large cap companies from belonging to healthcare sector, technology sector, banking sector, different sectors. Okay, so it is totally diversified index. Now, when we are choosing a diversified equity fund, it means that we should choose such an index which should be diversified, so that there should be an alignment between the scheme objective as well as the index, what index could be potential to perform. So these are some of the examples which can be chosen for a diversified fund. Now let's come to the sector fund. So we know that sector fund are those mutual fund schemes that invest in one particular sector. So there are different sector funds like real estate mutual fund, banking mutual fund. So there are different mutual funds that invest in one particular sector. There is this healthcare fund, technology fund. So focusing on one particular sector. Now, if we talk about banking fund, what could be a probable index? So a probable index could be BSE BankX. Also, it could be Bank Nifty. Okay, so that's in alignment with the sector. When we know that one particular mutual fund scheme that is investing in banking sector only, so we have chosen as benchmark. We as in fund managers have chosen the benchmark as the index that are investing in that particular sector only. So if it is IT fund, any IT sector can be chosen as index. If it is FMCG fund, then the probable index could be BSE FMCG. If it is an infrastructure fund, the probable index benchmark could be Nifty Infrastructure. If it is an auto fund, the probable benchmark index could be Nifty Auto Index. So this is just an example. There could be other parts as well. We have just taken to understand, to get an understanding that how does it work, what does alignment means, how the scheme should be in alignment with the benchmark, or we can say the benchmark should be in alignment with the scheme. Now it also depends on the choice of investment universe. Okay, this also you need to consider. We read about how scheme type influences the benchmark. Now how the choice of investment influences the benchmark, let's see. So we know that in mutual funds there are large cap fund, there are mid cap fund, there are small cap fund. So taking the example of large cap fund, the probable suitable benchmark index would be BSE Sensex or Nifty 50, because again we know that BSE Sensex comes with 30 large cap companies. So those large cap companies are well reputed in the market, that has been traded the most in the market. So those large cap companies are constituted top 30 large cap companies. Again, Nifty 50 comes with 50 large cap companies that has been performing well in the market. So they are considering the large cap companies in their portfolio. So if there is a mutual fund which is referred as large cap fund, again they want to invest the major proportion in large cap companies. So their probable suitable benchmark index should be Sensex or Nifty 50 as an example. If there is a mid-cap mutual fund which is investing a major proportion of money in mid-cap companies, so the probable suitable this benchmark index could be Nifty Mid-Cap 50, BSE Mid-Cap. So there are different indices. What index exactly do? Index is an indicator of changes in stock prices. Now we know that there are different indices. Before it was the major index was this Sensex of Bombay Stock Exchange, Nifty of National Stock Exchange. But soon with the growth in the capital market, there came to be many index related to Bombay Stock Exchange and National Stock Exchanges. So right now, just we are seeing how it is different. BSE 200, Nifty Infrastructure, BSE FMCG. So there has been different indices now which are available, which could be chosen as benchmark by the mutual funds. Okay, so if there is large cap fund, it should choose Sensex or Nifty as index. Then if it is mid cap fund, it should go with mid cap indices, and same way. Choice of portfolio concentration. It also depends on how many stocks have been included in the portfolio. So certain equity funds are there who are focusing on only what we say fewer stocks, so less than 30 stocks. Or then there are certain equity funds that focuses on many stocks to be there in their portfolio, to be in constructed in the portfolio. So here maybe the less than 30, here maybe more than 50, 100, 500, many stocks in the equity fund. Now how it should also be in alignment with the index, because when equity fund is considering fewer stocks, it means the suitable portfolio, suitable index would be Sensex because it consists of 30 companies, or it could be Nifty 50 because it consists of 50 companies. If we are talking about a mutual fund that is having many stocks in the portfolio, so the suitable one would be BSE 500, Nifty 500 if the stocks are 500 approx. If it is less than 500, somewhere between 200, so the suitable index would be BSE 200, Nifty 200, and as such there is also BSE 100, Nifty 100. So how many stocks are there in the portfolio? Now, considering all these criterias, the fund managers have to decide, or the asset management companies have to decide that what would be the suitable benchmark. It should be on the basis of scheme type, it should be on the basis of the market capitalization, choice of investment, it should be on basis of choice of portfolio concentration, how many stocks are there in the portfolio. So it should be in alignment. The benchmark should be in alignment with the scheme, or vice versa. The scheme should be in alignment with the benchmark. Now let's talk about benchmark for debt schemes. As per SEBI guidelines, the benchmark for debt and balance scheme should be developed by research and rating agencies recommended by AMFI. Okay, so rating agencies, we know that when we are talking about debt instruments like bonds, mostly they come with certain ratings which give the investor an idea whether these instruments are safe to invest or not. So the ratings are provided, which also shows the risk related in that particular fund. So that rating ranges between A to triple A, double A, B, double B, C, as such. So these ratings are provided by credit rating agencies, and they are the one who are also setting the benchmark for the debt schemes. It has been recommended by AMFI. So here in this chart, you can just get an idea how these are the benchmarks, and this is the scheme category, how they are in an alignment. So if it is an overnight fund, we know that these all are type of mutual funds. If it is overnight fund, then the suitable benchmark would be CRISIL overnight index. If it is liquid fund, then it should be CRISIL liquid fund index. So these all index has been constructed by the rating agencies CRISIL, which has been chosen as benchmark depending upon the scheme categories of the debt schemes. Also, when we talk about government securities, there are certain index which can be chosen as benchmark. It is like, for example, BSE India Sovereign Bond Index, BSE India Government Bill Index, Nifty GSEC Index, then IBEX. All these are certain index that are having the constituents of government securities, investment in government securities. Now let's look at benchmark for hybrid fund. So hybrid funds invest in a mix of debt and equity. Therefore, the benchmark for a hybrid fund is a blend of an equity and debt index. Okay, just have a look over this. We know that hybrid funds are investing the proportion of money in both debt as well as equity fund. It depends whether it is aggressive, balanced, or conservative, what would be the percentage of investment. So if it is an aggressive fund, 25% would be in the debt, 75% would be in index. So as such, when the index has to be chosen, the index should also be in the same constituent, because we know that aggressive hybrid fund is a mutual fund that would be investing about 25% of the investors' money in the debt scheme and 75% in the equity scheme. So there should be such an index which invest again in the same proportion. So 25% in debt index and 75% in equity index. So you can just have this example, like the debt index chosen over here is CRISIL Composite Bond Fund Index, where 25% allocation is made, and equity index is S&P BSE 200, where 75% allocation is made, and this hybrid index is called CRISIL Hybrid 25 plus 75 Aggressive Index. So this is how the benchmark is chosen in case of hybrid fund. If it is balanced, it would be 50-50 again, so debt and equity proportion. You can just go through it. Conservative, if it is, so 75% would be in debt index and 25% would be in equity index. So this is how the benchmark is chosen, and the main thing which you need to consider is that benchmark should be in sync with the mutual fund scheme, in consideration with the investment strategy, with the asset allocation, with the investment objective. It should be in sync with it. Then only, because when we are setting a target, we need to keep in mind that the target is going by how the fund is performing. So that target should be in alignment with it. Then only it makes sense. Now let's see some other benchmarks. So if we talk about gold ETF, that is gold exchange traded funds. So mostly gold price is kept as the benchmark for any such gold fund. If it is an international fund investing in certain international markets, so there would be different. For example, you can see this Chinese index, Hang Seng index, and then there is this US index, S&P 500. So this is how, if there are international funds investing in one particular international market, so they choose the index over there as benchmark. Standard benchmarks which we can consider for equity scheme, it is Sensex or Nifty. If it is long-term debt scheme, it could be 10-year dated government security. If it is short-term debt fund, it could be 1-year treasury bill. Okay, so this is standard benchmark which can be considered if nothing is available. Now let's come to quantitative measures of fund performance. So how does fund managers get an idea that what has been the performance of a particular mutual fund scheme? Okay, so that is also being measured. That is also quantitatively measured, which gives an idea. And these are some of the ratios that are widely used to show that how the mutual fund has been performing, how a particular scheme has been performing. So just see, it is used to calculate scheme return or fund return earned in excess of risk-free rate, considering the standard deviation as measure of volatility. Okay, so Sharpe ratio it is called. Now this ratio gives an idea, for example, that there is any particular scheme with with a portfolio of different companies in which it has invested. Now there is scheme return, maybe scheme has earned about 10%. Okay, just take an example that the return that has been that the scheme has been able to provide is 10%, and it is how much it is in the excess of risk-free rate. So risk-free rate is those asset classes which are not having any kind of risk associated. So for example, fixed deposit. When we are depositing our money in fixed deposit, we know that we would be getting somewhere around 7% or 6 to 7%. That is fixed. So there is no risk related. We know that certain percentage of return we would be getting after a certain period of time. So that is an example of a fixed security, and for example the government securities as well. So risk related is not there. So we know that we are certain that we would be getting certain amount of return percentage after a certain period of time. So such kind of financial asset where an investor is sure that he would be getting certain return percentage if he had made investment. So that is considered as risk-free asset. And whatever return is provided by risk-free asset is referred as risk-free rate. So when we are investing in mutual fund, investing in such schemes which are having certain risk associated, like equity funds, hybrid funds, so there are risk parameters associated. So when we are, as an investor, when we are taking risk, we assume that we get the return percentage that is higher than those instruments that is risk free. Okay, so in comparison with fixed deposit, if we are taking some risk, we want that we get certain higher return percentage. We expect that we get higher return percentage because we are taking risk, and we know that higher the risk, higher the return, lower the risk, lower the return. So if we are ready to take risk, we expect that we should get higher return as well. So here, this is the reason why Sharpe ratio is such a measure which considers that how much excess return has been provided by a particular scheme in comparison to those instruments which are risk-free. Okay, also considering the standard deviation. If there is any deviation, that should also be considered in the formula. So just have a look over this formula. Sharpe ratio is equal to RS minus RF divided by standard deviation. So here RS is scheme return, RF is risk-free rate return divided by standard deviation. Okay. In the same way, there is this tenor ratio. This is used to calculate again scheme return, or what we say portfolio return, fund return in excess of risk-free rate, considering the beta as a measure of volatility. So the only difference you can see in the formula is that in first one, in Sharpe ratio, standard deviation is considered as a risk measure, and here beta is considered as a risk measure. So we know that beta gives a more realistic picture because beta is considering the market risk along with the individual asset risk. We learned about this in our previous video. So standard deviation is only giving you an indication of a particular asset risk. However, beta is giving you an indication of risk in compared a particular asset risk in comparison to the market risk. So this is why in tenor ratio beta is considered, the market risk is considered, rest all it's same. We try to find out how much excess return has been there from the scheme as compared to the risk-free rate return. Then there is this Jensen's alpha. It is also used to calculate the same portfolio or scheme return. Now this is through another formula. It is in excess through CAPM model. So just see this formula RS minus CAPM. RS is scheme return as well. CAPM, just have a look over here. I have kept it in note so that you can just remember. RS is representing scheme return. RF is representing risk-free rate. So scheme return, it means the particular scheme which we are measuring how the performance, how it has performed, that particular scheme, how much return it has given, scheme return. RF is risk-free rate, so like fixed deposit or any such instrument where there is fixed return percentage being provided without any risk. So that would be considered as risk-free rate. Beta is market risk related, standard deviation is scheme risk, and then CAPM, it has its own formula RF plus RM minus RF into beta. So RF again risk-free rate, RM is here return from the market minus return minus return from a risk-free rate instrument into beta. So this is the CAPM formula. Now for your exam purpose, in your syllabus, Jensen's alpha calculation is not included, so you don't need to focus much on this. Sharpe ratio and tenor ratio would be more important as per your exam purpose. So you need to look at these calculations. Jensen's alpha has been not considered in your module, so I won't be showing you the calculation related to this. Now let's just see this calculation related to Sharpe ratio. So assume there are two funds, Fund A and Fund B. Now Fund A has given a return percentage of 12%. Fund B has provided the return percentage of 10%. Standard deviation, that is risk related to the scheme, is 10% and 15%. The beta has been given 1.1 and 0.9. Risk-free rate, let us assume and consider it is 6%. So if we are investing in any fixed deposit, we are getting about 6%, and that is totally risk-free. We are not taking any risk. Okay. So just consider this values as an example. And now if you are required to calculate Sharpe ratio, so we know the formula: scheme return minus risk-free rate divided by standard deviation of the scheme. So just put the values. For fund A, it would be scheme return is 12% minus risk-free rate is 6% divided by standard deviation. So standard deviation for fund A is 10. We would get the value 0.60. So this is how it is calculated. For fund B, again put the value: scheme return is 10%, risk-free rate is 6%, divided by 15. 15 is the standard deviation, and we got the value 0.26. In the same way, Treynor ratio could also be calculated. Just we have to consider here beta instead of standard deviation. So scheme return minus risk-free rate divided by beta of the scheme. So just put the values. For A, it would be 12% minus risk-free rate 6% divided by beta 1.1. In the same way, for fund B, 10 minus 6 divided by beta 0.9, and we have got the values 5.45 and 4.45. So this is if you get any numerical in related to Sharpe ratio and Treynor ratio, just keep this in mind and you would be easily able to solve it. Now let's move to this tracking error. What exactly it is? It is used as a measure of the consistency of the outperformance of fund manager relative to the benchmark. So in consideration with the benchmark, how the fund manager has been able to perform, has been able to outperform. It means has been able to perform well than the benchmark that was set. And the consistency. So there should be consistency in well performance in outperforming the benchmark. Now, tracking error is calculated as standard deviation of the excess returns generated by the fund. So just suppose that the fund manager has been able to provide excess return as compared to the benchmark return. So the benchmark return was somewhere 8%. However, the mutual fund scheme which a particular fund manager was managing, it has provided 10%. So it is 2% excess of the benchmark return. Now this should be consistent, like over the years, over 5 years, this should be inconsistent. Somewhere it is 2%, 3%, 4%, or maybe it can go down also. So this standard deviation, the more there would be fluctuations, like for 1 year it was 2% excess, for another year it went down and it was negative. So there, if this is what happening, if there is fluctuation, that is this means that there is standard deviation. There is deviation happening, differences are increasing, and that is what we call as tracking error. So it should be consistent. If a particular mutual fund scheme is performing well, it should be consistently performing well. If there are deviations coming, like for 1 year it has performed quite well, for another year it went down. So if there is deviation coming, it means there would be higher tracking error. Now just see the formula of tracking error. It is equal to standard deviation of portfolio return minus benchmark return. Okay, standard deviation of risk portfolio return minus benchmark return. Here it is represented. So this is the formula and this is how you calculate tracking error. So this tracking error should be low because we want that if a certain fund is performing well, it should consistently perform well and there should be a little deviation, there should be little risk related. So this is what tracking error shows. Now just attend these multiple choice questions. Which among the following is a measure of risk-adjusted returns of mutual fund scheme? A. Beta, B. Standard deviation, C. Sharpe ratio, D. Variance. So the correct option is option C. Which of the following cannot be considered for the purpose of selecting a scheme's benchmark? A. Investment strategy of the mutual fund scheme, B. Mutual fund scheme's investment objective, C. Scheme's past return, D. Scheme's asset allocation pattern. And the correct option is option C, scheme's past return. Once it is finalized, a mutual fund scheme's benchmark cannot be changed at a later date. State whether the statement is true or false. So the correct option is option B, false. Which is the most appropriate measure of evaluating how closely an index fund is tracking its benchmark? A. Tracking error, B. Asset under management, C. Total expense ratio, D. Tenure ratio. And the correct option is A. Tracking error. Dash takes into account all dividends generated from the basket of constituents that make up the index in addition to the capital gains. A. Total return index, B. Price return index. And the correct option is A. Total return index.